If you are looking for yield in a world where traditional savings accounts barely keep up with inflation, peer-to-peer lending platforms like Lenme often catch your attention. Lenme positions itself as an open marketplace connecting individual borrowers seeking small personal loans with investors looking to earn competitive interest rates. But before you move your hard-earned cash onto the app, you need to understand exactly how Lenme works, what real risks you face as a lender, and whether it deserves a spot in your investment portfolio. The core appeal of Lenme for investors is straightforward. You become the bank. Instead of depositing money in a financial institution that lends it out and pockets the interest margin, Lenme allows you to fund microloans directly to borrowers. You can set your own terms, choose your risk profile, and earn annualized interest rates that often range from single digits up to 20% or more, depending on borrower creditworthiness. On paper, generating double-digit yield on short-term loans sounds like an ideal passive income engine. However, the real problem investors face in peer-to-peer microlending is default risk. When you buy a dividend stock or a treasury bond, you have asset backing or institutional guarantees. On Lenme, many loans are small-dollar, short-term, unsecured debts. That means if a borrower fails to pay you back, there is no physical collateral for you to repossess. While some loans on the platform are crypto-backed, where digital assets serve as collateral, a large portion of personal loan requests rely purely on the borrower's willingness and ability to repay. This brings up the primary fear most investors have: losing their principal balance. High advertised returns mean very little if a string of defaulted loans wipes out your initial capital. Furthermore, Lenme charges subscription fees and platform fees to use their service, which means your gross yield isn't your net yield. If you earn 10% in interest, but lose 5% to defaults and pay platform fees on top, your net return might end up lower than safer, low-maintenance alternatives. So, what questions should you ask before putting money into Lenme? First, how robust is the borrower data provided? Lenme gives investors access to machine learning credit scoring, bank transaction histories, income verifications, and credit scores. As an investor, you must evaluate whether you have the time and skill to analyze this data for every loan offer you submit. Second, how does Lenme handle collection efforts when a borrower defaults? While Lenme connects late accounts with third-party collection agencies, recovery is never guaranteed, and collections can drag on for months. Third, how liquid do you need your money to be? Unlike publicly traded stocks or exchange-traded funds that you can sell at any time during market hours, peer-to-peer loans lock up your capital until the borrower completes their installment schedule. To navigate Lenme safely as an investor, here are key actionable takeaways to protect your money while maximizing returns. Never put all your capital into a handful of large loans. The golden rule of peer-to-peer lending is extreme diversification. Splitting $1,000 into 50 $20 microloans spreads your risk dramatically compared to funding two $500 loans. If one borrower defaults on a $20 loan, your remaining loans can easily absorb the loss. Next, pay close attention to loan parameters and collateral options. For lower risk exposure, explore loans backed by crypto collateral where loan-to-value ratios provide a safety buffer in case liquidations are triggered. For unsecured loans, set strict criteria on borrower credit history, debt-to-income ratios, and cash flow rather than chasing the highest offered interest rate. High interest rates usually signal higher probability of default, so balancing risk and reward is critical. Finally, test the waters slowly. Start with a small pilot amount that you are comfortable risking. Track your real net return over 6 to 12 months after accounting for defaults and fees, and only scale your capital once you have a proven track record on the platform. Lenme can be a viable tool for yield diversification, but only if treated as a speculative, high-risk slice of your overall financial strategy.